So I'm going to go through the macro and Steve's going to go through implications for the Australian share market. The outlook for the world is certainly to slow. So if you go back 6 months, most international forecasters, OECD, IMF, were talking about growth into 2025, but we're now pre-downgrades, particularly in the developed world, so Europe and North America, but also we've got some downgrades coming in China and India, but we don't actually know by what extent, and how quickly they'll come on board, because it is a moving feast in terms of the negotiation around tariffs. Inflation was projected to ease in 2025. Now we don't know, particularly in North America with tariffs. There's only one way inflation can go, and that's up. And that's because of the import pricing pressure. Also, there was a forecast for energy prices to decline, particularly because of Trump, because he was going to increase production coming out of North America. It looks now that that's going to accelerate on the downside, but there's only so far it can fall. In terms of Australia, we see cost pressures moderating, and China deflation may accelerate. China's deflation was appearing like it did pre-COVID. We saw that beginning to appear in the last 12 or so months. It may well accelerate with these trade negotiations going on. We'll cover that. Australia has been going through a income recession in terms of wages have not been growing as fast as inflation. There was a catch-up going on, but if you look back to COVID, wages were about 10% below cost of living increases over the last 4 years. Where come interest rate adjustments down, you can be a little bit more bullish here given what's going on in America. If there is a downturn in America, you can say that there'll be an acceleration of interest rate cuts, and the outlook for the forward yield curve is potentially 1% over the next 12 to 18 months, cut in interest rates. Then we've got the US Australian dollar dilemma, which we've talked about endlessly. Australian dollar weakened very dramatically after the tariff announcements. We fell about 5 or 6%, and now we're up 5% back to where we were. In terms of just looking through what's going on with Trump, we can talk about a game of chess. Arguably, Trump doesn't play chess; he plays cards, but that's a bold statement. Okay, so let's just go back to the play for Trump. We've had the tariffs being threatened and used with a targeted outcome. What are those outcomes? The outcomes are to try and balance the trade account, to try and slow the American economy and get the fiscal deficit down. And unknown is what the target is in terms of currency, but also to deal with the bond market and try and lower the cost of debt to the American government. I'm going to cover all of those as we go into the charts and tables. In terms of the implementation of tariffs, what may happen, it may drive Europe, China and Asia closer together in trade. And I think that's come to the forefront in recent discussions. So I don't think that's a risk, that's more a likelihood. Already China is talking to its neighbours in the last few days about pushing forward on closer trade and manufacturing alliances. There is the preliminary discussion, which was prior to these tariffs, the US, the Trump administration had been asking Europe to increase their defence expenditure into NATO. I think that's a certainty to occur. And I've said this on a few views recently that Europe's investment in defence is positive fiscal policy in terms of supporting growth. So if there is positives, there is stimulation going to happen in Europe anyway through fiscal policy in the manufacturing sector. Trump clearly has to get inflation under control as he renegotiates the massive American debt. One way of doing it is driving down the oil price. The oil price will fall with supply coming out of North America, and if there is any dislocation in economic growth around the world, demand. And that's playing out as we speak. Oil price sitting around $60 a barrel, about 30% below where it was 6 months ago. What may happen in terms of risk? The devaluation of the Chinese yuan. We're already seeing China devalue slightly, and that's against the very weak US dollar. And we'll talk about that again in the charts. But before we go on our journey, let's remember the crisis is normal, and this is just covering the last last 14 or 15 years. It's fairly regular events that something happens. So now we've got the 6th event since the GFC, and the GFC was a major event. So we don't need to go through each of these, but as investors, we have to acknowledge that there's always turbulence coming at some point in time. Some of it is black swan, some of it's white swan. I'd actually say that what Trump's doing now, it's more element of white swan because he flagged it. He's been flagging it for 20 or 30 years. So it's not as if it's a black swan event we didn't know about. So let's look at the charts and just see what they're saying. There were downgrades in terms of world growth appearing after very strong 24 growth around the world. I expect those arrows to point further down, but I don't see a worldwide recession. That's the point. We're not looking at negative worldwide growth. It's interesting when you look at debt, and this is all about, there's two big issues. It's the trade account of America and the budget situation of America leading to a debt problem for the American government. And there's the three major economies. America's debt, everything surged during COVID. America's debt's beginning to go up again, and its debt's beginning to grow faster than its GDP. Similarly, in China, very significant government debt growth. So we've got our two biggest economies in the world, around slightly above or slightly below 100% the GDP. Europe, which was the basket case coming out of the GFC, has managed to decrease its debt to GDP by growing faster than its debt and also getting some fiscal policies, and particularly Southern Europe, under control. There's always a question about who owns America's government bonds. And if we scan across it now, we see that government bond ownership is around 75% Americans, American citizens or corporations or pension funds, and 25% the rest of the world. The extent that the rest of the world has invested in bonds has been declining as percentage of all bonds on issue. The biggest owner of American bonds is the Central Bank of America. The big question mark we have today, looking out, will that increase or decrease? Now, how significant is the deficit problem? This was up to the end of February, I think. So October to February, with still 7 months to go to the end of the fiscal year of America. The deficit, even after 5 months, was running well over $1 trillion. So we're heading to a deficit in America of somewhere north of $1.5 trillion to $2 trillion. There are seasonal flows in terms of tax collections, which you have to be aware of, but it is deep in deficit. Interest bill is going to rise. And why is it going to rise? Is because if you look at the previous page and dissect it, the interest being paid by American government is about 2.5% of its debt. Well, if you look across the American bond market, nowhere is interest rates 2.5%. So it's all historical debt. And bonds issued in a previous period, a lot through COVID, obviously, and that debt's going to be rolling into higher interest rates in the bond market, plus new debts being issued. So if the American government's got $2 trillion deficit, it's got to issue $2 trillion of bonds to fund current year deficit, and it's rolling over $6 trillion of bonds each year. So about 20% of its bonds roll. The fiscal deficit, which deteriorated rapidly during COVID, has begun to get worse again. So you could talk about COVID being an aberration. So if we take COVID out and just look at the trend line from 2015, it's just up and up and up. Trend going from $500 billion deficit 10 years ago, heading towards $2 trillion deficit now. Pretty steady line apart from the aberration of COVID. But COVID did add substantially to the debt load. Okay, so some discussion points. Now, I think we've outlaid the issue with America, which the Trump administration is addressing. The American economy has attracted a massive amount of worldwide capital. You can see it on all its external accounts, trade and income accounts. So it's running a massive external deficit, and it's also running a massive internal deficit. The internal deficit was substantially funded for a while going into and out of the GFC by China. China was a big supplier of capital to America. It seems to have stopped about a decade ago. This view that China owns a lot of American government debt is wrong. As you saw my earlier chart, it's about $800 billion out of $32 trillion. So it's a big holder, but not a significant holder. Would China sell those bonds? Well, if we had another deterioration in a negotiation, which hasn't started, between America and China, you may well see that sort of kamikaze act. But at this stage, they haven't done that. And that's where they hold a substantial part of their foreign reserves. If you think about it, that's $800 billion of their foreign reserves sitting in the American bond market, which they can use if they need to bring it home to stimulate their own economy. So they do have quite a lot of firepower. That's not the case of America, okay, who's excessively borrowed off the rest of the world. The allocation of capital and debt to the American economy, and Australia is falling into this trap, and we need to be aware of it as self-directed retirees and advisors. There's an increasing concentration risk by being invested in the US. Now, when it works in your favour, as it has clearly in the last 2 years with revaluation of the American stock market 20% compound, with a rising US dollar, and expansion of PEs, but also earnings growth. So everything's a huge tailwind for American assets. You'd have to say now there's quite a significant headwind appearing. Now, you could say that also is self-inflicted because of the administration change and the change in policy, but that's what it is. It is actually existing in front of our faces. To a lot of extent, investing in America the last decade against a rising increase in debt and a declining fiscal policy and trade account, we did so, the world, when I say we, the world external to America did so with our eyes closed. We were happy to take the risk because we're getting the return. That's, to an extent, is now unwrapping, and we can see clearly the risk we're taking by investing in America as they now have to deal with their issues. Those issues are clear to see. So it goes to the third dot point, American government deficits and debt. I remember saying last year I thought 2025 would be a year where the bond market awoke from its slumber. Well, it's being shaken out of bed by Trump. And the US bond market is exposed. Government debt needs to be addressed. The government deficit needs to be pulled down, and so does the trade account. The overvaluation of the US dollar needs to be thought about. Now, I've got the fourth dot point there, and I end the sentence with, we'll need central bank support. And I'm becoming more increasing to the view, and I'm not alone. I think that if you go and listen to some deep thinking analysts on YouTube and listen to some analysis, and if anyone's interested, I can send them to you. There's an increasing view that the central bank will need to get more involved. Now, my view is the Central Bank of America is just watching events unfold. I liken the American economy now to a plane landing, and there's a lot of people trying to land this plane on the plane, and the central banks running the radar, trying to help it land. So there's people working on the currency, there's people working on the trade account, there's Elon's working on the fiscal account. Hopefully the wheels are coming down so they can land, but there's a lot of work to be done to land and stabilize this plane. After they went through it, they've actually driven into a storm. A plane can go around the storm, they've driven into it. So they've really got all hands on deck trying to work out, and they've created arguably more problems than they needed to, but there is a big problem to address. I suggest that the central bank is watching and saying, we'll see how you go, see what you can do on the trade accounts, see what you can do on the inflation, see what you can do on oil, see what you can do with your fiscal situation, see what the US dollar does, but they are ready to act. They may not be ready to act if Trump is in full control, because you have to understand where we sit. He's taken over war powers to take directional control of massive international policy settings away from Congress. So he's doing it without their approval. He's making unilateral decisions with his cabinet. Now, at this stage, the Congress seems to be happy for him to run, but don't be surprised if they get worried and they try and pull some of those controls off him. I don't think the Federal Reserve will move with Trump being totally in control, so to speak. The administration, the Federal Reserve, and Congress, Treasury all have to work in unison at some point. But at this stage, it's the administration with Treasury who are running ahead of the pack. The issues are significant for America. They have to be addressed. Arguably, this administration had to address it because the next administration would have to do it. We can debate about how they've done it and the ramifications, but don't think that the Federal Reserve will not act if it has to. Now, we can't regard that as an insurance policy, and the insurance policy is printing of money, but I think we are heading to a point where America follows Japan in terms of printing money, and we've got history in Japan, debt to GDP 250%. They didn't implode, they printed a lot of money, and they took over the bond market. They forced out foreigners. And the more I think about it, the control of the bond market is going to be essential for these policies to be driven through the American economy, okay? And the warning we got last week where the bond market got destabilised suggests quantitative easing is coming back. We have to do a lot more thought about that because there's various scenarios which flow from that. One argument says that's very bullish for asset prices. Another argument says, well, that could be quite depressive. So it's not an open and shut book. Okay, and remember Japan had 20 years of rolling recessions, printing money, very low interest rates. Very low interest rates don't mean massive stimulation in economic activity. They might mean speculative activity, but not economic activity. Clearly, if the tariffs roll through, we've got inflation rising in America, not declining. So US inflation was on a substantial downturn. The recent inflation reading in March was negative for the month. So that's going to start going up again. So we've gone from looking at absolutely certain interest rate cuts to now no interest rate cuts unless there's a downturn in the American economy. And we're too early in the cycle. Tariffs have just been implemented to some extent. Threatened tariffs haven't been implemented. American economy has not even dealt with the issues as yet. So we can talk about the risk of, which Steve's done, the risk of recession, but at this stage it's a risk, not an actual, and markets are moving all over the place trying to work out where a recession. So everyone's watching the numbers, so are we, and we'll keep you informed. In the meantime, we're adamant. If you are thinking about investing, you want to be well diversified, more than normal, and you want to probably be more focused on yield more than normal. And it's not as if yield is not available. If you go back to COVID, we had no yield, and luckily we were all at home looking at the TV, because if we're looking at the markets, you would have been panicking in terms of where do I get a return for my money. There has been a substantial recovery in income markets. The cash rate in Australia, as you know, is well over 4%. It was close to 0.25 or something, 0.1 in COVID. So that's 4% better. Inflation is coming down in Australia. I've put to you the case where there's an argument that China may deflate its trade partners through excessive exporting away from America. That would drive inflation further down. We've had a substantial decrease in petrol prices coming from international oil markets. Petrol today in Sydney is about $1.50, $1.60 a litre. We see across Australia petrol prices coming below $1.50. They were $2 a year ago. Electricity is still a concern as a cost of living issue. We've got mortgage rate cuts coming, probably as soon as May, and a second one probably in August. So inflation readings and the cost of living seem to be improving. So the yields we're seeing compared to inflation outlook, they're becoming quite attractive in a world which is becoming quite disjointed. So we're suggesting from the investment team to talk to your advisors about, there's not many times you need to rethink about asset allocation, but I think the jolt suggests it's time to rethink. And if you're not prepared for excessive volatility and you'd like to see more yield, we do have the solutions available. We've been thinking about this for quite a while, so it's not something we just came upon. We've been thinking about restructuring our income fund inside Clime, and that's showing a much better yield. Developing new products to go into the corporate debt market and the mortgage market at much higher yields than generally available, acknowledging the risk, and we can explain the risk to you. Acknowledging that we think the equity market, whilst it'll still perform over a long period of time, there's going to be some issues given what's going on around the world today. So that's the presentation. I hope that made sense.